Hey everyone, Rob Stanley with the Seller Growth Podcast, and today I've got Chris Shipferling from Global Wired Advisors. What's up, Chris?
Hey, Rob, how are you, man?
I'm doing great. So this will be a really interesting one. We've had people kind of on the show talking about buying Amazon companies, but today we're going to be talking about why are all these Amazon brands and aggregators for sale? Like there's so many for sale, and there's of course a lot of companies
Yeah,
buying them. So this will be an interesting one, Chris, and I'm looking forward to hearing what your perspective is on this. So
absolutely.
let's kick this off and welcome everybody. First, hit that like and subscribe. And if you do get a chance, post some questions in the comment section, and Chris and I will be happy to reply to those. So we'll just kick this off right now. And so where is this new capital coming from, Chris? Like there's just seems like an influx of capital right now to all these companies to buy, whether it's a seller or an aggregator in our industry. Help us out here.
Well, it's not a new concept. I mean, the term arbitrage has been used for quite some time, whether it's arbitrage from a consumer product perspective or arbitrage from a multiple perspective. Private equity has really always kind of played the game of multiple arbitrage, where they buy a specific asset or a company for, call it a 7-8 multiple, and hold for 3, 4, 5 years, and they're able to then sell it again, right, for a much larger multiple. Pretty much day one that the company was purchased through private equity, it's worth more than it was the day before, right? And so this idea of arbitrage has been around for some time, and really that's what we're seeing right now. We saw some early adopters to this multiple arbitrage game, where they saw, hey, Amazon brands are starting to have real staying power. They have brand, and now they're starting to get real cash flow, where 4 years ago, maybe 5 years ago, that wasn't the case. When you had the FBA gold rush of 2015, it was a lot of new brands, and a lot of people dismissed these brands because most of them were side hustles, or they were purchasing product in different categories. There wasn't a whole lot of consistency to the brand. And then over time, as the brands got more staying power, got more vertically focused, and also started growing in cash flow, the value of that company went up. And so that's really where you kind of see the genesis of this new capital coming in. So to the question, where is it coming from? Well, it's coming mainly right now from venture debt and some equity sources. So they've done, you've got about close to 80 different aggregators. They say that they've done, a new raise, and they sent out an announcement, a PR announcement about that raise. And majority of that is debt funding. It's not cheap, but it's funding to help fund both what we call the operational alpha, which is really the back end shop, the ops function of the business, and then also to go out and purchase and acquire these Amazon-based brands. Typically 70-80% revenue concentration needs to be on the Amazon platform. And so that's the other unique piece, is that there's always been a lot of platform risk around Amazon, but with this particular capital, they're fairly risk averse to the Amazon platform. And surprisingly, a bit ironically, they actually don't like businesses that are majority off Amazon. Most of these new quote roll up or aggregator companies that have been able to raise most of this venture debt and venture equity. So that's the answer to where is it all coming from and how did this thing start?
Yeah, no, that's a great answer. Especially it's crazy out there. It's a little Wild West, sort of. Kind of reminds me of the early 2000s, kind of the obviously we had
the bubble.
The bubble. But if you look, we got the stock market's going nuts, the housing market's going nuts, the Amazon market's going nuts.
Yeah.
So it kind of it's just kind of a pyramid. Everything's following that way, right? It's a big arrow pointing up right now. So we did actually have a question come in. Somebody was asking, and hopefully you can answer this because this is definitely out of my league, but they're asking what the difference is between a business broker, and a professional investment banker? Hopefully you know the answer to that, because that's definitely a little out of my league.
We usually ask that question when we go, I wonder who that came from. That's a curious question.
Must have some followers out there, Chris.
Interesting question. Only because we've done a lot of content around that, kind of really distinguishing between what a traditional business broker process looks like and what a more of an investment banking process looks like. We could probably spend the entire show on it. So not to get completely rabbit trailed here, I'd say it really boils down to ability and process. And if you were to start with ability, typically, a business brokerage is made up of lots of 1099, what I call desk guys. So they're really licensing a name per se. It's a lot like real estate. And so what were their backgrounds prior to getting involved in, say, financial markets? It's a myriad of different things. Some own their own business, they sold it, and now they believe they've got qualifications to now sell companies and get heavily involved in mergers and acquisitions. Some had just corporate jobs. Some I've even seen some things come around, not in our space, but I saw an announcement of a new broker of a brokerage here in town. He was a fireman like 2 weeks ago and a chief, and now he's selling businesses. It's just a little disjointed. So that kind of gives you a little bit of flavor of kind of, what a business broker kind of background or ability looks like. They typically don't come from any of the bulge bracket investment banks or any of the larger financial services companies that are out there. And so that's really around ability on the broker side, ability on the investment banking side. You typically, and specifically for our firm as well, you typically have managing directors or managing partners that have spent time in the bulge bracket investment banks. That would be the Wells Fargo, the Bank of America, the Citibanks, call it just Wall Street experience, working on very large transactions. And even if not coming from, say, bulge bracket, coming from at least middle market investment banks, working for folks like Piper Sandler, other various boutique middle market investment banks. Typically with an investment bank too, and this market isn't there yet. And again, this is a whole other podcast, I promise. Yeah. But typically investment banks have what's called a broker dealer, and it's just not needed right now. Although our investment bank is headed towards that registration. And really what that means is you're able to broker securities. So whether that means you're brokering specific securities, equity securities for a transaction, or for public equities, or you're selling bonds, or you're selling debt. That's typically why an investment bank will go broker dealer, but it's not needed to specifically take on a company and sell that particular business. And then it's process. So I'll go through this very quickly. Business broker has a very quick process. It's very passive. It's not very, I would say, active. Even though you've got some folks claiming that they do a lot of data pull, that they do a lot of kind of data mining, the reality is the difference between that process and what an investment bank will do is almost night and day in terms of the procuring of industry information, true data about that industry, as well as the company is our client, and also comp data, right? So a bunch of competitor information, and then really highlighting the opportunity. And then we take it out and we create a market versus just hitting a button and blasting it out to a huge buyer list. So like I said, there's a lot to it. One is more sophisticated and up market, and one isn't. That's really, if I were to boil it down, that's pretty much it.
Yeah, no, that's great information. And, once again, so I'm Rob Stanley, Chief Marketing Officer with AccrueMe, and welcome back to the Seller Growth Podcast. And I've got Chris Shipferling, and we're talking about he's from Global Wired Advisors. We are talking about why all these Amazon brands and aggregators are for sale. And so let's spin this a little more to the sellers. Okay. Let's see how we could maybe help them or give them a little more information. So if our listeners want to go directly to one of these funds, what should they expect, Chris? And don't answer that yet. We're going to answer that right after this commercial.
This content is brought to you by AccrueMe, the business-friendly funding solution for Amazon sellers. If you're a profitable Amazon seller looking for capital to grow your profits, click the link around this video or visit accrueme.com for a no-risk funding estimate in less than 3 minutes.
Yeah, so head on over to accrueme.com, fill out that form. Be sure to mention the Seller Growth Podcast or Rob or Accrueme Podcast, one of those, because I would really appreciate it. Hit that like and subscribe, 2 thumbs up. We'd appreciate that. And once again, I got Chris Shipferling from Global Wired Advisor, and he was about ready to answer a really great question for everybody who's listening on if our listeners wanted to go direct to one of these funds, what should they expect?
Yeah, they should expect a few things. I mean, one, I think if you really believe that you have a commodity business, if you believe that you don't have a brand that's worth strong value and has a potential for, I'd call it just multiple bids from lots of different potential strategic partners, then yeah, I would say go direct to any fund, because if you believe that bid from that fund and that deal structure from that fund is identical to the other 80, of course you'd go by yourself. Of course you'd go alone, right? You just go directly to the fund, you'd sell the business, you have a liquidity event, and perhaps you thought maybe I never could have had a liquidity event. And you get your check, you get your deal done, and you move on, right? But the reality is there's also a lot of pitfalls to doing that. Behind a lot of these names that are now getting lots of venture debt and equity, they came from some pretty important roles in large investment banks. And so, if you believe that you can go to the mat with these M&A teams to get the deal structure that is fully optimized, and you believe you've got the chops to be able to go through the due diligence and also the closing, then sure. I think you might be in a good position to go at it alone. But when you do go alone, you don't have a representation. You are going to be starting off from a position of weakness, not a position of strength when it comes to negotiating. I'd say that's probably number one. Number two, if you don't have extremely clean financials and extremely clean books and just all of your data is packaged in a very organized way, you're going to run into some pitfalls, because like anything else, if they sense anything wrong with the numbers, they're going to look at it as an opportunity to then try and get a better deal for them, not you, right? And then even just down to simple things like, it's not simple, but just a simple term like the asset purchase agreement, really having what I would call someone as a quarterback to walk you through all of that, not just your lawyer. Your lawyer gets paid whether the deal gets done or not, right? An intermediary gets paid only when the deal actually goes through. So it's really important, in my opinion, to have a trusted, experienced advisor that's walking you through all of that due diligence and, of course, all the closing, walking you through the documents and giving their point of view to really help when it comes to the business structure of the deal versus just the legal structure of the deal. I mean, I could give you countless amount of times where, we've been able to introduce our clients to some really strong legal firms, and we use one in particular that we really like, fairly large middle market M&A firm. And there are times where when we're combing through and find detail of that APA, there are some things that we're able to catch, not a ton, but there are things that are fairly material as well. So yeah, I would say that's when you would want to go at it alone, is if you really believe you've got a commodity and you don't think that you've got a brand that would procure a lot of different, I would say, attractiveness from lots of different acquirers.
Yeah, so piggybacking off that, once again, I got Chris Shipferling from Global Wired Advisors here with me, and we are talking about why are all these Amazon brands and aggregators for sale.
Once again,
I'm sorry. So piggybacking off what you were just talking about, let's go into a little bit of, let's kind of help out some of the sellers and people watching. What are some of these investment people looking for? Like specifically, let's say in the Amazon seller side, but then there's like the aggregator side also. There's got to be something attracting them to certain ones versus others. What have you seen on that, Chris?
Yeah, I mean, look, I think if you've got a really great brand, if you've got, and that's a vague term, but if you've got a brand that's got, real staying power, it's got real loyalty, your sales growth is very strong, your cash flow is equally strong. You've got still a lot left in terms of opportunity and runway to grow the brand from where it is today to where it could be in 2 or 3 years. You've got to bid for your company pretty much across the board, from aggregators to financial sponsors, which I would call private equity, family offices, all the way up to corporate strategics, to really pay attention, especially if you're at a specific EBITDA level. But really what separates, I'd say, the wheat from the chaff, a lot of these aggregators are going after cash flow. I've seen them purchase businesses where I just had to shake my head and say, that is a really, really interesting purchase. That's definitely not probably number one on my list. And I'm not even just saying that from a pure subjective, perspective, but I would say it just wasn't a great brand, but it had cash flow. So they were purchasing that cash flow. And I think that is definitely the difference with an aggregator bid and aggregators who are really desperate, some of them, not all of them, desperate for that cash flow and buying that Amazon brand because they've been funded and they can't let money sit in the bank. They've got to go purchase businesses. And so that versus a call it private equity, family office, corporate strategics, they're going to be looking for more of what I described in the beginning. And also they're going to be looking for something that is of value to them, right? So like specifically in a corporate strategic, they're going to be looking for what we call a tuck-in acquisition or a roll-up that really fits the brand, maybe the actual brand that is the corporate strategic that you're talking to. So let's just say it's in pet and it's a larger pet company. Maybe you offer something, whether it's market share, you've actually been stealing some of their market share, so that's interesting to them, or you've got a product or IP that they think is really intriguing that they could take, and you may be only on Amazon, but they go, hey, we've got lots of shelf space out there and lots of other sales channels, as well as the sales infrastructure and marketing infrastructure to take you from just this one place all the way over to, say, these other 5 or 6 places and grow the company almost immediately. Those are the types of things that a corporate strategic is looking at. And private equity tends to kind of look at it a bit similar. It's got to be a really good fit. Typically, the funds that are raised, in private equity, they've got a strategic direction they want to go in. Aggregators do too, but it's just a bit more broad. Aggregators are looking for cash flow and what's the revenue concentration. And then sometimes they're looking and going, is this a bit too commodity? But I mean, I've seen some commodities get purchased in this space that private equity never would touch with aggregators.
Yeah. So in my head, I was kind of thinking like, okay, for the Amazon side, when it comes to the brands out there, I kind of was trying to look at it, and maybe you could correct me on this, but I was looking at are some of these buying, like, let's say they offer a 3 to 5x type multiple on it. Are they looking at it as, okay, we are pretty sure that we could get in here and, increase the profits on this company by 20, 30% or this brand, and we'll get our money back pretty quickly that way? Or are they sometimes looking at it, if they pick it up at a 3, 4x, hey, this is making good, steady money. This could last for, 6 to 8 years. We'll ride out that 3, 4x to get our money back. And then after that, it's just a windfall of, money coming in. But I was just kind of curious, like, is that a couple ways they look at it? And then on the aggregator side, are they also looking at the IP, the intellectual property, possibly? But don't answer that yet. We got a quick commercial break. And we'll be right back.
This content is brought to you by Accrume, the business-friendly funding solution for Amazon sellers. If you're a profitable Amazon seller looking for capital to grow your profits, click the link around this video or visit accrume.com for a no-risk funding estimate in less than 3 minutes.
Yeah, so we'll go back to the Sell Growth Podcast. I got Chris Shipferling from Global Wired Advisors, and I was just asking more on the question we were just talking about. That basically are some of these companies that are buying, let's say the Amazon brands, Are they looking at just basically like adding fuel to the fire to make more money? Or are they kind of just writing it out where it could be a long-term investment and they'll get their money back? Then on the aggregator side, I was asking about intellectual property as maybe something that attracts them to that. So what's your take on that, Chris?
Yeah, it's a bit broad. So I'd say, the short answer is yes to all the above. Typical private equity will purchase, for a fund, and then they're looking at a 4 or 5 year path to really flipping that over into the middle market. They want to take something that is at least the types of businesses that we take to market. Let's say it's firing off $3 million of EBITDA today. Private equity firm buys it for 7 times multiple. So all in is a $21 million enterprise value. I mean, they're looking to try and get that to a $10 million EBITDA in the next 5 years and try and sell that now for $100 million. That's kind of where their mindset is most of the time. With aggregators and IP, it's a good question. Yes, I think IP always plays a role in the conversation, but I mean, I've heard of deals that have been in transactions that have gone off where there's no IP. It's just trademark. So really, it's just the brand itself. So I'd say in private equity, it plays a little bit more of a role when it comes to valuing the business and placing stronger enterprise value on the company. But when it comes to specific aggregators, I don't think it necessarily it's not playing front stage, but for some of them it is. I mean, you got 80 of them out there and they're not all the same. That's also why, going back to a previous question, it's about, should someone go direct? Well, the reality is, unless you believe everyone is the same, but they're not. Different aggregator funds have different strategies and different categories and how they view businesses. So some are placing some stronger, I'd say, chips in the IP bucket, and others aren't. Some are placing more chips in the brand bucket. Others are not. So yeah, you've got differing opinions, but you're going to, of course, have that when you have 80 different funds that are out there, just in aggregators.
Yeah, they're going to all have their own motives and ways of doing things for sure. Mm-hmm. And hey, real quick, everybody, be sure to hit that like and subscribe. I would appreciate that. And once again, I got Chris Shipferling from Global Wired Advisors, and we're talking about why are all these Amazon brands and aggregators for sale. I laugh every time because it's so true. There are so many. But we did have a question come in, Chris. So this is a pretty, I want to say, broad question, but I'm sure you can at least come up with a good answer. Somebody was asking, why are private equity companies interested in e-commerce based businesses? I think you did answer a little bit, but is there a little more to that? Like, why are they taking such an interest? I mean, hey, why aren't they jumping on the Bitcoin stuff, or something like that instead?
Well, I think. Yeah, and I can answer this. This is definitely a topic I think that would take a whole other podcast too. But I think to try and be succinct, when you've got venture debt and you've got venture equity that comes into a space, that's usually kind of the first wave in all capital markets. I mean, nothing's new under the sun when it comes to what's currently happening in this particular space. And so, it's like the Grand Canyon in some ways, right? So if you've been to the Grand Canyon, you see all the geological eras that are in the rocks. I'd say that the venture debt, venture equity, and the aggregator is, kind of aggregators that are out there is just kind of one sliver. And usually what comes next is that true private equity and family office money. They usually come a bit later after, venture debt and equity is usually the canary in the coal mine. And they usually come after all the mistakes have been made. And but they'll pay up for businesses, businesses that have been in a particular ecosystem or a sector. They're starting to mature. And so instead of the 3 to 4, 4.5, which, by the way, that's a whole other topic, multiples are starting to definitely go up. But the 3.5 to 4 kind of traditional multiple, private equity will come in and see value because a sector is already maturing and start paying up for good businesses, because those businesses that are still around in that top quartile will be great businesses to purchase, and they're great assets. And so why is now private equity coming in? I mean, there's a couple reasons, and I mentioned it earlier. So venture debt usually comes in. They're also not scared of cash burn, but most of these businesses are cash flow positive since day one. That's actually kind of fast forwarded why private equity is wanting to sniff around and buy an e-commerce based business. Number two, there's got a lot of staying power now with Amazon based brands and just e-commerce based or D2C based brands in general. And they're also becoming real brands. I mean, that sounds so silly to say, and it sounds really just kind of not, it doesn't really sound very professional, but it's the truth. They've become real brands, and they've got, and part of that is kind of playing hand in hand with the staying power. On top of that, though, and what's really kind of pushing this massive paradigm shift is COVID, period. Right? I mean, you saw this wave, this paradigm shift occur through COVID, and that in itself is now having lots of staying power, right? You've got 7 million new consumers using the internet for commerce, number one. Number two, you saw 10 years of e-commerce sales penetration fast forward in 3 months. Everybody is quoting the McKinsey report back in July. Reality is there's tons of reports that are out now throughout the full year and even going into this year that's showing that e-commerce is not going anywhere. I just read an article this morning, happy to send it to you, Rob, later, that basically the whole premise of it was just this, that this isn't slowing down anytime soon. It's probably going to continue lasting until just the strong growth within e-commerce is going to last at least until 2025, if not 2026, at about the same rates that we're seeing the growth that occurred last year going into this year. So positive news for anyone who's involved in e-commerce, I can tell you that. But part of it is a larger macro reason why private equity is getting in. And then I also kind of outlined some of the more micro reasons.
Yeah, it's interesting you mentioned that article. I don't think I read that one, but I did read one about kind of the housing market. And the housing market, they're predicting 2023 to 2025, it's still going to keep growing into that time frame, which, I mean, it's crazy. It's absolutely nuts out there right now in the housing market. So
I saw today, I saw something where I guess commercial real estate is starting to tick back up, not because people are wanting offices, but they're buying this land and these office buildings to tear them down to build housing.
Oh, that's an interesting approach right there. Yeah. Not
Malls
to get
are
too much off subject.
Malls are going away and getting torn down. And I specifically saw an article around to build distribution centers for e-commerce.
Yeah, no, that's crazy. It seems, like I said, I was kind of saying, like, the whole thing with the pyramid. It's like we got the economy going that way, a stock market going that way, all these aggregators and everybody buying them and buying, the e-commerce seller type people. It's all going up. It's going nuts.
It is.
And now, do you think, and this is a question I actually came up with, do you think, Chris, that, I mean, there could be a bubble, at least in this sort of e-com boom that we're seeing of, all these people buying all these companies? And I mean, what's your thoughts on that?
Well, you want to say yes, because, our minds always want to play in a vacuum, and they always want to be as myopic as possible. But when you really kind of lens out, when you see that every 2 minutes there's someone new on the Seller Central platform, I don't know if that actually starts to support that there's a bubble right now. Maybe later down the road where, it starts to get way too overheated and overvalued, but most of these businesses are still way undervalued when you look at typical middle market multiples, right? For consumer products, those averages over the past couple of decades have been really between 7 to 13, if not up to 15 multiple, right? So, I mean, we're still undervaluing a lot of these brands. I still think there's a lot of runway. Now, with a bubble with aggregators, I mean, probably you're going to have a bit of, it's going to be a little top heavy on how many new funds have been raised specifically to buy Amazon based businesses. I think that, there might be a bit too much competition, but look, we live in a capitalistic society. Capitalism tends to take care of that problem, right? Where when you have too many, some of them are going to fail, and that is natural. It's very natural for that to happen. And I think that that's probably what we'll see more so than just a bubble being burst and everything getting devalued, right? Or deflation. I think you're going to continue to see e-commerce brands go up in value, but maybe you'll see a little bit of a bubble with just this particular type of fund. But then again, there's thousands upon thousands of private equity funds that are out there buying all types of businesses and consumer products. So it's a question mark.
Yeah, for sure. You know, one interesting thing you never read, right? Like it sounds like you and I read a lot of very similar articles, and they're always talking about this many people this year signed up to sell on Amazon, right? There's all these sellers jumping on there. Where's the number on how many of those accounts are static? How many never, actually created a product? They just went and opened it and then never did anything with it. How many stopped selling? Like they don't ever want to share that. They want to talk about the millions of people selling on Amazon.
Yeah.
But the truth is there's a lot of accounts out there that are just static. So that's a pretty interesting one.
Yeah, you probably, I think probably like anything, and this is a bit this is kind of law of stats. It's like an 80-20. You probably have, 20% driving 80% of the revenue, and the rest are just exactly in that bucket that you just described.
Yeah. Yeah. It's always that's true for a lot of things. I mean,
it is. It's true.
Look at how many people still have eBay accounts, but nobody sells on it, right?
It's true. It's
eBay
true.
probably could claim they have more accounts than anybody, but the truth is, how many are really selling? Or sell occasionally. So it's just interesting. You see all these stats about new sellers. But anyways, we're going to move on. We got definitely more for everybody. So hang tight. We will do a quick commercial, but the question coming up next will be, what are the 3 things business can do to make their company more attractive to these acquisition, companies that want to acquire you? So hang tight after this quick commercial break. All sellers are looking to grow their business. Why not take advantage of the Accrueme.com Grow Now and Pay Later option? Accrueme is not a bank. They truly only win when you win with growth capital funding. What are you waiting for? Head on over to Accrueme.com now. Be sure to mention the podcast. Yeah, so if you head over to Accrueme.com and fill out that free 3-minute estimate, no commitment, be sure you mention the Seller Growth Podcast or Accrueme Podcast when you're filling out that form. I really appreciate it. Should be a drop-down menu coming up here soon that you can just select it. But so welcome back to the Seller Growth Podcast. I've got Chris Shipferling from Global Wired Advisors, and we are talking today about why are all Amazon brands and aggregators for sale. It just seems like everybody's for sale right now. So I did leave before the break asking Chris this question. I'll ask it one more time just so everybody who's jumping in. What are 3 things businesses can do to make themselves more attractive to these buyers? Chris, take it away.
Oh man, a lot. I mean, number one, I'd say understand your financials. And again, I'm going to speak in very broad terms. I'm going to speak in things that I'm going to try and get as deep as possible. And definitely something that, by the way, anybody who's listening, contact us. I'm happy to have long conversations about it, any and all of this, and really try and make it a bit more customized, say to your particular brand, your particular company. But know your numbers. I mean, that's pretty simple. Hire a really good bookkeeper, a really strong, kind of call it financial function within your business. Really knowing where your numbers are from both, P&Ls, profit and loss statements, understanding your cash flow, your 13-week cash flow, how that marries up and ties to your inventory, and also your inventory planning. This plays a lot with you guys, actually, Rob, really knowing your financials and understanding where your potential cash flow pitfalls are going to be. It's really important. Having monthly meetings with your finance function, which would be, a bookkeeper or a fractional CFO. And we've got lots of resources for fractional CFOs as well as good, solid, call it bookkeeping firms. I'm sure you do as well, Rob. So that's number one. I would say, number 2, understand and know your data, really understand, find the right software programs that will help you read all of your metrics, understanding, what is it really costing me to acquire a customer through Amazon? What is it really, what's my call it my true ACOS, my tacos. I mean, we can go down the line of all different types of metrics, but just really knowing your data, really making sure that you are intentional about that you're running reports to understand that data. And then and also kind of understanding the data, I'd say really have your processes mapped out. understand what your SOPs are, and go through that. We have a really, really good partnership with a firm that a consulting firm that helps with that process mapping. It also helps with your SOPs. And so that's also something else. If anybody out there is looking for a resource, definitely can help there. So I'd say the third too, you're a consumer product company, know your product roadmap, right? You're gone are the days where you can just guess on Alibaba and get the garlic press and try and sell it. That's gone. That ship has sailed. You've got a lot of competitive pressure now on the Seller Central platform. You got a lot of competitive pressure out there just in general. And, when you work for middle market consumer product companies like I've worked for, you spend the time, you do a 3-year product roadmap, and you do that. And it's also aligned with your 3-year business plan. Now, year 3 and even year 2 are a little murky, but year 1, that's pretty much kind of set in stone. And having a product roadmap, knowing where the business is going and being able to firmly, confidently know exactly based on data where the company is going and where it's growing from your particular focused vertical, the product extensions that you're going to be creating, and also forecasting what all of that's going to look like. Wildly important. And when you take all 3 of those and you package them together, really what it shows any acquirer is you understand your business very, very well. You're able to articulate your business very, very well. And number 3, you also fully understand what the value of this business brings anyone who becomes that acquirer.
That's a lot of good information. We've covered a lot today. So yeah, anybody who just tuned in, here's a couple things for you. If you want to get a hold of Chris, head on over to accrumi.com, check out the podcast area. You can rewatch if you missed any of the great questions that Chris just answered, and B, actually the contact information is right there. When you click on it, it'll be in the description area, so you can actually get a hold of him that way. And just once again, if you did tune in late, I got Chris Shipferling from Global Wired Advisors. He just gave out a great bit of information on why are all these Amazon brands and aggregators for sale. I can't stop laughing every time I say it. But
everyone's
Chris, it was
man.
Yeah, it was absolutely amazing having you on.
Thanks,
and appreciate you so much being on the Seller Growth Podcast. Chris and I had this great conversation offline, not even before start. It was like a few weeks ago. Yeah. And when I was getting ready,
you believe that?
Yeah, no, it was amazing. We talked about some great information, and I was like, man, we got to get on and get you talking about this. So once again, everybody, be sure to head on over to accrumi.com, check out the podcast section. Again, the video's over there. It does take a little bit to load, but it should be there by the time you get over there. And once again, check out Chris Shipferling from Global Wired Advisors. And Chris, thanks again for being on the Seller Growth Podcast.
Thank you, Rob. Appreciate it.
Take care.